Hey guys, it is Patrick, and before you dive into this lesson, I wanted you to know that you're about to start a new section of Principles of Accounting, and you can actually head to my website at www.patrickleemsa.com, where you can actually purchase and then download and then print the worksheets that go along with this lesson and all of the lessons that are connected to this section of Principles of Accounting. It's a great way to take notes so that you can actually concentrate on what I'm teaching you in our lessons, and then you can able to write notes along with the notes that I am showing on your screen. So all you have to do is head to my website at www.patrickleemsa.com. There you can purchase them and then download them, and then you can use them on this and all of the lessons that are connected to this section. So go ahead and do that. And if you are ready, let's head into our first lesson in this section right now. Hey guys, welcome to section 6. In section 6, we're going to be looking at merchandising operations. These are operations that have to do with inventory. So we're going to introduce you to what we would call inventory and the process of selling inventory and what the journal entries would look like when a company brings in inventory and then subsequently sells inventory from merchandising operations. Now, if you don't know what merchandising operations are, that's okay. In this lesson, we're going to be taking a look at service industries versus merchandisers. So if you're ready, let's get started here with kind of giving you an understanding of these two types of businesses. Now, we can really drill down the different types of companies into 3 categories. So if we were going to take a company, we can drill it down to or put it into one of these categories. And those categories include service companies. These are companies that provide service as a form of how they make money. We also have merchandisers. Merchandisers are companies that provide goods in the form of what we would call inventory, which they have not produced. And that's a key word, is merchandisers typically do not produce their own inventory. And I say typically, there are some industries in which the merchandiser does also produce their inventory. But for this purpose, let's assume that they are not producing their own inventory. And then we also have manufacturers. So manufacturers are those companies that provide goods or inventory that have been produced from raw materials into finished goods. So let me give you an example of each one of these. So service companies would be like Southwest Airlines. What is their main purpose? Their main purpose is to provide you a service, transportation service, from one point to another. If we look at a merchandiser like Target, what does Target do? Target buys inventory or goods from manufacturers and then puts it in their store for you to buy. And then we've got manufacturers. So a manufacturer would be someone like Coca-Cola or Frito-Lay's. What do? They transform raw material, so for Coca-Cola, sugar, water, syrup, into Coca-Cola cans, Sprite. They're actually taking the raw materials and transforming it into a finished good. For Frito-Lay's, they're taking flour, maybe corn, water, and transforming that into chips that you buy at the store. So those are the 3 different types of companies there are if we were to break it down. Now, again, this doesn't mean that companies don't overlap other ones. So if we go back to our example of Southwest Airlines, they are a service company, but they also sell stuff on their planes and at the airport. And so they do dip a little bit into the merchandiser area because they're not a manufacturer, but they do dip into the merchandiser, but that's definitely not what they do. What do? They provide a service. That's their main source of revenues for that company. So when we look at that, that's what we're talking about. Now, in this course, we're only talking about service companies or merchandisers. So we're going to leave manufacturers to what we would call cost accounting or principles of accounting 2. So we're going to focus strictly here on service and merchandisers. So some key difference from an accounting standpoint, and we've been talking about companies as if they were service companies up until this point. So if you really think about everything that we've talked about, we've really talked about those companies that provide a service. So what's the difference between what we've been talking about and merchandising companies and the accounting standpoint? Well, the key difference between service and merchandising companies is what we would call inventory. Merchandisers have inventory, service companies typically do not have inventory, and that's what makes it a little bit different. Now, inventory is what we would call items that a company sells to its customers. So if we think about what does a company sell to their customers, that is inventory. So for instance, you might go to, let's say, a office supply store, and you could buy this box of staples, right? So a company like Staples, for instance, will buy these staples from from ACCO Brands. That's what it says on the back here, ACCO Brands. So they buy this from ACCO Brands, and the whole point of them buying this box of staples is to sell it to the end user. So this is called inventory. Okay, so whatever they expect to sell to their customers would be inventory. Now, for instance, they might also buy, for instance, let's say this is a pencil. I mean, it's an Apple pencil, or I think that's what it's called. Anyways, it's an Apple pencil. Let's say they use this to take orders. So this is not something they would sell to a customer. This is for their internal use. This might be called, for instance, supplies. Okay, so there is a difference between supplies and inventory. Inventory is what a company would sell to their customers. Supplies is what a company would use in their normal operations. Okay, so that's kind of the difference there. So inventory is what we call items that a company sells to its customers. Now, when we buy inventory for our businesses, inventory is considered an asset when we first acquire it. So when we buy this box of staples to sell to our customers, this becomes inventory in the form of an asset. This is an asset. Does it provide future benefits for the company? It absolutely does. How? We can then sell this to a customer and make money, which will usually generate more money than what we paid for this inventory item. Okay, so this becomes an asset when we first buy it and we bring it in to our company. A company doesn't expense the cost of that inventory until it is sold, and that is because of the matching principle. We're going to match the expense to the revenue. So if I were to buy this from ACCO Brands for $1, I will book this inventory item into my books as inventory for $1, and then when I sell it, then I will expense that $1. So we don't expense it when we buy it, we expense it when we sell it. And that's one of those accrual accounting things that you're going to have to think about. Is it becomes an asset first, and then we sell it. When we sell it, it becomes an expense. So looking at some of the difference between service companies and merchandisers, we've got some financial statements that we can look at. The first one here is the balance sheet. So this is an example on your screen of a balance sheet for a service company. Notice we have cash, AR, supplies, prepaid insurance, and equipment. Now let me go ahead and put on the right side what a balance sheet would look like for a merchandiser. So for a merchandiser, notice we have cash, we have AR, but we also have inventory, in this case of $92,000. So in a merchandiser company or a merchandising company, they would have inventory on their balance sheet. Notice that we also have supplies. So we can have supplies on our merchandising company because they're going to need supplies to operate their business. Pens, pencils, maybe boxes to ship product out to their customers. So there are supplies that a merchandising company may need as well. And then prepaid insurance. Now some people might ask, why didn't I put equipment here? I could have put equipment here below, but I wanted to keep it kind of the same for aesthetic reasons. All right, so that's the balance sheet. Let's take a look at the income statement now. Notice here on the income statement, we've got service revenues and then operating expenses. Operating expenses would be all the other expenses that the company incurs to operate their business. Okay, and then we get to net income of $45,000. Now here's the difference with our merchandising companies. For our merchandising companies, notice that we also put something called cost of goods sold. So we've got revenues of $125,000 and cost of goods sold of $50,000. Now I'm going to explain this later on, but to give you a little bit of preview of what cost of goods sold is, cost of goods sold would be the company's cost of inventory that they've sold to a customer. Keyword, it has been sold to a customer. So we said that this cost us $1 from ACO brands, and then when we sell it later on for, let's say, $2, once we sell it, we will expense this cost of $1 on our books. Where does it go? It goes into an account, a new account for you called cost of goods sold. So we have a cost of goods sold of $50,000. So if we were to say, look at this, we generated $125,000 of sales from inventory that only cost us, the business, $50,000, which means we had a gross profit of $75,000, and then from there we pay our operating expenses. So that's kind of how we look at it from a merchandising company. Okay. So let's review some of the differences. Service companies earn revenue from providing a service, whereas merchandiser companies earn revenue from providing sales, the sale of goods in the form of inventory. Merchandisers have inventory, which is a current asset because we don't expect it to be around for longer than 1 year or the operating cycle of a company. And when they sell their inventory, the cost gets transferred to cost of goods sold. Again, we'll show you that a little bit more later on, but usually we'll take the cost of the item, we'll put it through the inventory first, and then when it's sold, we're basically transferring the cost from inventory to cost of goods sold. So we'll go over that later on when we show you kind of a picture of how that works. So that is kind of a introduction or an understanding of service versus merchandisers. In this section, we are only going to be concerned with merchandising companies, those companies that buy product in the form of inventory from their vendors. They put it on their shelves or they put it in their warehouse, and in turn, they basically flip that product or inventory to their customers at a higher price, therefore giving them a profit at the end of the day. So that's services versus merchandisers. I hope you enjoyed this lesson, and we'll see you in the next video. Hey guys, it's Patrick. Before you skip ahead to the next section, just wanted to come on here and tell you to not forget to like this video and maybe share this video with someone that you know that would get a lot out of this lesson. Maybe a classmate that you know. This would be a great way to introduce them to this channel. So share this video with them, maybe your mom or your dad, someone, so that they know that you're really learning accounting topics here on YouTube and you're not just playing cat videos over and over again. Now, if you want to help us grow this channel, what would be great is if you press the subscribe button and maybe even turn on the notification bell if you want to get alerted the next time we upload a video to this channel. And put in the comment section below, what did you eat last night? It would be so weird for people to come and look at the comments, but what did you eat last night? I might throw in a comment after you if you put that in the comment section below. So do that now. What did you eat last night? All right, so enough of the fun stuff. Hope you enjoyed this lesson, and we'll see you in the next video.